Just to remind you who I am, I'm Harry Nimmo. I've been running smaller companies at Standard Life since 1993, and I've actually been at Standard Life since 1985, making a total of 32 years. And I had a career in the construction industry before that. But what it does bring experience. And I see a smattering of ages here, but it's fair to say that the demographic is towards the older level. So you have been through economic cycles as well. Now, I've been running smaller companies since '93. I launched the Standard Life Smaller Companies Unit Trust, as it was in those days, in 1997, and we took on the Edinburgh Small Companies Trust, now named the Standard Life Smaller Companies Trust, in 2003. So we've been through many cycles, and there have been some terrible times. If you remember, even back to the third quarter of 1998, I was in all places doing a presentation in the Majeski Stadium in Reading to financial advisors, and I can tell you there was panic in the room. Markets had just fallen 25% in 3 months. It was the Russian-Asian crisis, and the world didn't end. The same thing happened 2000, 2003. Markets fell by in excess of 50%. And then, of course, we had the banking crisis, where it really did look like the end of the world. And indeed, particularly if you're living in Edinburgh, where your two largest banks, largest employers doing their best to go out of business and take all their investors with them. It was a bad time. But actually, investing in smaller companies over that period produced outstanding returns. And I did a little exercise recently. It's fortunate that there's a bit of history here, 20 years of funds. How long would you have had to hold our smaller companies fund to get 10% per annum return? Which I think you'll agree is a decent return. 10% is a decent return. Well, the answer is 6 years. Doesn't matter market timing. You could have bought it in, well, exactly 10 years. Well, the peak of the last bull market, probably exactly 10 years ago, you still made 10% per annum. Sometimes a lot higher, but that's as bad as it got. So my advice to you is to just buy smaller companies and hold them. And to be honest, I've listened to some very insightful presentations we've had today, but I'm pretty confused. I'm not really very good at the top down. It's actually very difficult to predict the top down. Who knows where the currencies are going to be, what political events are going to occur in the next year or next 5 years even. Anything can happen. So what we do is we concentrate on the bottom up. We look at the companies, we hold great companies for extended periods. So we're trying to find tomorrow's larger companies today. So clearly I'd want you to have smaller companies and have our smaller companies trust. And as I actually speaking to a guest here today in the back, and he said, "Oh no, I don't touch smaller companies. Way too risky, way too risky." And that's a fair point. On average, they are riskier, but they're not all risky. We actually self-select the less risky, smaller companies. And it's one of the insights that I hope to talk to you, if I've got time today, is that actually in smaller companies, lower risk equals higher returns. Lower risk equals higher returns. So just a little bit of definitions here. Sometimes it's pretty confusing as to what the devil is a smaller company in listed company terms. And this is actually quite a confusing slide too, but I'll try and explain it to you. I mean, you may realize that the top 10 companies in the UK are worth at least a third of the entire market in 10 companies. Royal Dutch at number 1, the Reckitt Benckiser at number 10. And indeed, the FTSE 100 has got around about 80% of the value of the whole stock market. Into Properties happens to be the company at the bottom of the FTSE 100. Now you go below that. Smaller companies are the bottom 10% of the stock market, and actually I should have put 90% there. So, and the benchmark that measures this is the Numis Smaller Companies Index. So it's that bottom 10%. It includes half the FTSE 250 mid-cap index as well, includes the small cap. And it's all companies below about 1.5 billion. And off to the side, you also have AIM stocks, alternative investment market. And that's not in the FTSE All Share, it's not in the Numis Smaller Companies Index, but it is investable for smaller companies. And that market has actually become better in the last 25 years. It's had its ups and downs, massive ups and downs, but it's become better, more diverse, higher quality businesses coming there, and as I'm sure you all know, it's got some rather interesting tax benefits as well, inheritance tax and the like. But I haven't got time to talk about this, and anyway, who knows what the next Chancellor might do. He might consider this as a bad thing, a bit of a giveaway. I don't think so, because it does encourage the development of very dynamic companies that are employing and are growing people. I would consider the AIM market a success story. So it's the bottom 10% of the stock market, below the radar for most investors, smaller than a 1.5 billion market cap. Many of them are faster growth. They're very focused businesses. They're in niches. It's easier to grow from 100 million of sales to 200 than it is to clearly to go from 100 billion of sales to 200 billion. There's many founders running these businesses that have decent, large stakes still, that have a vested interest in the success of the business, and they're not about wasting shareholders' equities with their equity in their own business with highly dilutive rights issues and acquisitions and the like. There's a lack of analysts' coverage down here. Many of them are under-researched, and that gives us our opportunity. Just a couple of graphs, and believe me, it's reflected around the world. Smaller companies have outperformed over the longer term, wherever you look, pretty much. The UK and the US. And the UK actually, in the 61 years since 1955, smaller companies have outperformed by 3.5% per annum. And a similar situation in the US, and you do get this compounding effect. These are log scale graphs, but there is obviously a strong compounding effect that helps people like Warren Buffett and Berkshire Hathaway look really good, because they've been around for so long that you have this compounding effect that goes on and on and on. But smaller companies do outperform. Now, many people say to me, well, they're riskier, and actually there's a frictional cost of buying and selling smaller companies. The costs of getting out, getting in are really, really expensive. Well, what I say to that, and I've said it to you already, and I'll say it again, buy less risky smaller companies to overcome the risk question, and hold them for longer, so you don't have to trade them. So over the years, we've developed 6 principles for successful smaller company investing. And these might seem pretty simplistic, but we find it works. And we find that it works in the longer term, and we find it has worked since we've been involved in smaller company investing. Look for sustainable growth. Go for quality. That's lower risk. Run your winners. And I suppose you've got to cut your losers as well. Concentrate your efforts. And we have a powerful screening tool we call the Matrix for picking stocks. Management longevity is a good thing. management change is a bad thing. Lots of investors say, oh, we look for management change so we can get in new management, sort it all out. Well, we haven't found any evidence of that. And valuation isn't everything. Value is not important in terms of our screening process. Now, I don't think you've heard any fund managers talk about that. Even smaller companies, if you buy a basket of cheap stocks, you're just buying problems. You're buying a profit warning in the post, a dividend cut round the corner. It is the most overrated measure in investment. Look for sustainable growth. There's a myriad of growth sectors to choose from. I've just picked half a dozen and a few companies beneath that in each sector, which I'm sure many of you will have heard of. Some of them are household names, and the bulk of them, our funds own 5% or more of. CVS, the vet business, vets and pets. Now, our colleague, I was coming down the plane and she said, oh, I'm just so tired of your colleague talking about the humanization of pets. I'd never heard this expression before, so it's quite a good one. It's part of the family. The pet is part of the family. It sounds brutal, but when I was a lad, you put down sick animals. You do not do that today. They have diabetes. They have the similar problems to us. You inject them every day with insulin that costs thousands of pounds a year. They are part of the family. And expenditure, brutally, is going up in that part. So Dechra Pharmaceuticals, a distributor of animal veterinary products, pharmaceutical products. CVS is the largest owner, listed owner of vets in the UK. Just a couple of mass affluent brands. We've all heard of Ted Baker, listed on the stock market in 1997 at £1.50. Today it's £28. It's been in our open-ended portfolio all the way through. Hotel Chocolat and Jules, similar mass affluent brands, more recent listings. These companies, successful British companies that have become successful outside the UK. And that's one of the things we really look for. That's exactly it. It's a smaller world, and with the help of the internet, if you see something that works in the UK, the likelihood is that, and if you see evidence of this working overseas, it can make the company a very, very much bigger entity. There's very much a convergence of taste around the mass affluent in the world. Healthcare services. Just a couple of things here. NMC, it's a big hospital group in the Emirates. It's a top 5 holding with us. Medica, a recent issue. There's a shortage of radiologists at the moment that's causing a major opportunity. Specialist software companies, Accesso, GB Group, and First Derivatives in big, fast data. First Derivatives based in Newry in County Armagh, 700 million market cap company. It's a leader in financial services software for chasing down insider dealers and market manipulators. That it's not safe for them any longer. They can spot unusual share trading patterns in a blink of an eye and stop trading. It's bought by exchanges and regulators, and they've used this big fast data in many other sectors. They're showing success in aerospace, in market analysis and the like. Online niches for imprint. It's in the US. It's a distributor of market research material. Consumer choice and provenance. I mean, I'm not going to talk about Fever Tree. Every small company manager chortles on about how successful they've been in that one. But I think it is a good example of how tastes change out there, and some of the very largest branded companies are frankly hoodwinking their customers by producing substandard brands that they are value engineering to take out cost, and with the assumption that the customer will ultimately not notice it. We all know about the Cadbury's cream egg story, but it's similar stuff like that. Hilton Foods and Cranswick have benefited from the horse meat scandal. You remember that, about 5-6 years ago, when this was the sort of thing what was being done to meat. Now, the major supermarkets are extremely careful these days about their supplies of pork and beef products, and they use trusted suppliers like Hilton Foods and Cranswick these days. Cranswick is also benefiting from you may or may not have heard of a phenomenon called the fifth quarter. That's in the fifth quarter of there's only 4 quarters of a pig, but the fifth quarter is the bits that used to be put in the landfill site that are now shipped off around the world, quite often to China, to Spain. It's the ears, the trotters, other bits and pieces that there wasn't a market for in the UK. There is a market now, and it's in the East. Go for quality. My goodness, I'm running out of time. Go for quality. This is how we do it. We look at companies, sounds pretty obvious, that have revenues, make profits, and pay dividends. But there's plenty of companies out there that don't. We like cash flow. We like companies that pay special dividends. We like visibility of earnings, long-term contracts, customer relationships over many, many years. We like negative working capital, pricing power, and this last one, Altman Z-scores. Altman was trying to predict for his, he's a professor actually, but he did work for the Ecclesiastical Pension Fund, I believe, in the US, and trying to spot companies, he's a bond person, that were going to go bust. So we try and spot companies that are going to go bust so that we can avoid them. And this is work done by Professors Dimson and Marsh of the London Business School. They took baskets of low beta, low specific risk stocks, high specific risks baskets, and high beta stocks. So they compared risk with returns. And the 2 pots that did the best over an extended period were the low risk boxes. So the academics are coming around to our way of thinking that low risk equals higher returns. Running your winners. Now, I mean, this is just over the last couple of years. It's our top 2 holdings. All I'm illustrating here is that quite often you say, oh, there's a tendency, if it goes up, let's say something goes up by 20%, you want to sell it. And if something goes down by 20%, you want to buy it. Well, our view is if you're buying great companies, you just hold it. You just run your winners. And that company that is great and getting better and has momentum just keeps on running for years and years and years quite often. And that is where the most returns, holding great companies for extended periods. Concentrate your efforts. This is just a schematic on our matrix. We have 13 factors that go in to it. It's electronic. It's updated daily. It's about quality, growth, and momentum in the main. So we tilt it. This is our fund, and this normal distribution is the overall market. We tilt things towards the high numbers, and we also use this matrix score if we see low numbers for selling stocks to get rid of the bottom category, the sell category. In the middle is the hold category. So we keep true to our process, and it's also provides a more predictable sort of performance. And actually, because we're lower risk, our best years are actually in the bear markets. Our best years, relatively speaking. Now, I know everybody here is more interested in absolute returns, but we actually, against our competition, tend to lose money less quickly in bear markets. And in those terms, '07 and '08 were great years for us, as was '01 and '02 and 1998. We like personal manager responsibility. We have a tight-knit team. There's only 6 managers in our team, covering UK, Europe, and global equities. And this really helps us, this screening process, to cut down the legwork and just concentrate on those factors that our backtesting has shown have driven return. Now, management longevity. All I'm going to say here is this is our top 10 in our Standard Life Smaller Companies Trust. And 4 of them are run by founders. And this is the year when these companies were either founded or the current chief executive or chairman or leading light was appointed. And that next number is the number of years of tenure. So we have there NMC, Dr. Shetty. I couldn't really pronounce his first name, but phenomenal. 41 years running that business. He's still the chairman. Some of these other ones, there we have JD Sports, Peter Cowgill, 21 years. He's seen off Sports Direct. He's seen off JJB and the other people. They're doing phenomenally well at the moment. And they're also making a success of their business outside the UK. There's First Derivatives, the Newry-based company I mentioned. Founder Brian Conlon, still running the company, still owns a third of the business. Ray Kelvin is a bit of a legend. Founder of Ted Baker. He founded it as a franchise in a long-defunct Glasgow-based department store called Goldberg's. Listed in 1997. He still owns a third of the company. Half his sales are from outside the UK. It's got a long way to go there. This is a bit of back-testing work. I won't spend too much time on you, but it's really just to illustrate value in smaller companies gave you underperformance, whereas most of these other factors gave you outperformance. This is for European small caps since '07. And this is just coming back to our Standardized Smaller Companies Trust. We took over this one in August 2003. It's been a great story. It was a bit of a basket case when we took it on. So the discount was 35%, and now it's 5%. So on that alone is a good thing, a great thing. It's a one-off, really, given that we now have discount protection. We buy in at 8%, but we have issued shares at a premium. But you can still see the NAV performance is pretty respectable against the benchmark, and in particular, the FTSE 100. Avoid mega caps in all circumstances, I would say. But I am a smaller company investor. Dividend growth. This is the dividend track record on our trust. There was a bit of sorting out to do at the beginning, the first few years, but then we really got a bit of momentum here. Dividend growth over the last 10 years, compound rate of 23.5%. So off a low dividend yield, but compound that up, and if you bought this in 2007, you'd be making a very handsome income. That dividend growth has fallen to, I would say, about 15% per annum over the last 5 years. I think we can at least manage double figures for the foreseeable future. These are growth companies. The dividend growth of the trust reflects the earnings and dividend growth of our underlying holdings. So these are what I'm calling the rules here. Principles, rules, call it what you like. Just buy smaller companies and hold them for a long time. I really feel that it's wrong personally, as a personal view, for investors to, if they can manage equity investment, equity risk, they can manage Standard Life Smaller Companies Trust risk. So really, that's all I have to say. Thank you very much. Thank you.